Hi guys, it's Stephen from HDQ Chartered Accountants, and today I just want to cover the basic principle behind the flow of taxation, particularly for the discretionary trust and company structure. Now this is particularly useful for property investors or even business owners, and it's very common to use a mix of these structures to manage your tax affairs. So let's start with the discretionary trust. What is it? It's basically a relationship. So it exists to separate legal and beneficial ownership. So what this means is one person can own something and somebody else can benefit from that something. So let's say if HDQ Family Trust in this example owns property 1, the legal owner in this case would be the trustee, because the trust itself isn't actually a separate legal entity. That would be separating the legal ownership. And that's also why you get a layer of asset protection. Now, the second half of the definition is separating the beneficial ownership. So if property 1 brings in a benefit, which would be the net rent, let's say about $20,000, that means that the trust can collect that $20,000 and be able to distribute it to the beneficiaries. So let's say we've got person 1 and person 2. Their taxable income is already at $250,000 and 0. What that would mean is if we wanted to get a favorable tax outcome in this example, the controller of the trustee would say, hey look, I want to distribute all of the benefit that HDQ Family Trust holds to person 2 so that we can lower our average rate of tax downwards. Because person 2 isn't working, once we add on their $20,000 benefit, their taxable income will end up at $20,000, which means that they probably don't have any tax to pay after your low income tax offsets. But in a different scenario, if we had this $20,000 assessed by person 1 instead, that would take their income to a total of $270,000, with that actually $20,000 distribution being taxed at 47% at individual rates. So we can understand that this is a very useful tool if you have a large positive portfolio towards retirement. Now, let's think about the company structure. The company normally is used for business affairs. Let's say we have a net profit of $100,000. What happens is that if we retain a net profit of $100,000, it means that we can pay the company flat rate tax at 25%. That means that our company tax would be $25,000. This leaves the cash amount left at $75,000. So what happens next depends on who is the shareholder. So let's say if the shareholder was an individual, what would happen is in the next financial year, to access the $75,000 worth of cash, the company would have to pay out a dividend of $75,000 to the individual. What will happen, assuming they have no other income, is that they will be taxed on the 75 dividend amount. And also there will be something called a franking credit gross up. Equal to 25% that the company would have paid at the company level. So this means that as an individual, you're taxed on 100K at individual rates, but to avoid double taxation, we will less a 25% franking credit, which is the tax that the company has already paid.